All right, hello everyone. Thanks for checking in to today's technical analysis lesson. We are going to talk today about the concept of fast move one way, fast move the other way. We could see that on a lot of different charts. For example, here we have our S&P 500. Notice back here, fast move one way, fast move the other way. Now, let me explain why this happens. This level up here is called resistance. When a market's moving higher, there's not enough supply to fill all the demand. And when we get to so the buyers have to be willing to pay a premium. When we get to resistance level, well, we got a lot of sellers. So a lot of times the market reverses off of resistance. Sometimes a level that was resistance can convert into support. We can see this on a lot of charts. Resistance becomes support. This happens because we have remorseful buyers. I'm sorry, let me say that again. We have remorseful sellers. People sell, and when the price goes higher, a lot of these sellers regret selling and they tell themselves they're going to buy their shares back. But they're only going to do so if they can get them for the same price they sold them at. So if we have enough of these remorseful sellers placing buy orders at the level that was resistance, it turns into support. Here we have the opposite. Support turns into resistance. This is because of buyer's remorse. We have people who bought here who regret doing so when the price goes lower, and they tell themselves, I made a mistake. I want to get out, but I'm only going to do so if I can get out at break even. So they offer their shares at the same level they bought at. And if there's enough of these remorseful buyers placing sell orders, the level that was support turns into resistance. And here we can see some more of this concept, right? Fast move up, fast move down, fast move up, fast move down. And I'll explain why this happens. Fast move up, fast move down. But let's look at another chart. This is our consumer discretionary ETF, and we can see very clearly here resistance becomes support, support becomes resistance. All right, so that's within basically like a point. People people sell. They thought they did a good job when the market went lower, but when it goes higher, a lot of them tell themselves they're going to buy their shares back. So if we have enough remorseful sellers placing their buy orders at the same level they sold at, what was resistance can become support. We have people who bought here who regret doing so when the price goes lower. And if there's enough of these remorseful buyers trying to sell to get out of break even, what was support becomes resistance. So we see here, resistance becomes support. And again, here we have our fast move up, fast move down. Now, why would we have a fast move up, fast move down? Well, we know one of the reasons why there is support is because we have remorseful sellers placing buy orders, and that creates support. Now, when we rip through levels really quickly, like we did here, well, when the trend changes and we get back to those price levels, because we rip through these levels so quickly, there's not a lot of people who had a chance to sell. So if people weren't selling, there's not going to be remorseful sellers trying to buy their shares back. So you can notice this is what we call a gap. There's an old expression, gaps refill. And if you understand this concept, it's pretty easy to understand why a gap would refill. There's just not a lot of vested interest in here because we move through these levels so quickly. So move higher, not a lot of sellers who regret buying or regret selling. So on the way back down, sellers have a hard time finding buyers. So fast move up, fast move down. We can see this on a lot of different charts. Even here, fast move down, fast move up. So this helps with your trading because it can give you an idea of like, all right, well, this thing that I'm buying here, the last time it was at these price levels, it traded through it really, really quickly. So there's not going to be a lot of vested interest. So that means there's probably not going to be a lot of sellers around. So if I buy it here, it's a good chance we make a quick move higher. And I just pulled a random stock out. I literally just closed my eyes and just hit my keyboard, and the first letter I typed was I, so I brought up International Paper. And we could see this here, right? Fast move down here, fast move up here. We go through these levels so quickly that there's just not a lot of time for people to buy who are going to regret doing so. Um, there's just not going to be a lot of time for there to be a lot of vested interest, right? There's not a lot of time for there to be a large amount of buyers who are buying shares who are going to regret doing so when the price gets lower. So when the market reverses and we get back to these levels, well, the people that come in to buy, they have a hard time finding sellers. So they have to be willing to pay a premium, and that's what forces the uptrend. Same thing over here. Fast move down, fast move up, fast move up, fast move down. One of the reasons for support is remorseful sellers trying to buy their shares back. Look at this. In this gap here, well, it never traded there. So if it never traded there, no one could have sold it, right? So if you don't have anyone selling, there's no remorseful sellers trying to buy their shares back. That's going to form support. Here we got fast move up, fast move down. Here we have a complete gap, right? Closed here, opened here the next day. Over here we have the total gap. So if it didn't trade in these levels, well, there's no one who could have bought it who wants to get out. So you've heard the expression gaps refill, and this is one of the reasons. This is the reason why. Fast move down, fast move up, right? Fast move down, fast move up. Now let's look at this next chart. So this is rice. Now I know a lot of you probably don't trade rice, but the same principles apply. And we can see here, fast move up, spend some time trading sideways. When we get back into these levels, fast move down. Spend some time trading sideways. We get here, fast move up. Here we got a fast move down, fast move up. So when we're going down really quickly, there's just not a lot of time for there to be a big amount of people buying who regret doing so, who want to get out at the same level that they got in. So you're not going to have these remorseful buyers creating resistance with their sell orders. Here we get the fast move up. What's one of the reasons why we get support? Well, because we have remorseful sellers trying to buy their shares back. If we rip through these levels really quickly, well, there's not a lot of time for a lot of vested interest to form. So there's not going to be a lot of support over here. So now when people come in and want to sell, well, they're going to have to be willing to sell at discounts, and that forces the downtrend. So fast move down, fast move up. So you can see this on a lot of charts. Might sound a little bit strange, but if you understand this dynamic of buyer's remorse and seller's remorse, it makes it much easier to comprehend. And even right here, we have support becomes resistance. Resistance becomes support. All right, so remember, always let the market tell you what to do because the market is never wrong. Don't guess. Look at your charts. Try to understand what they say. If you look at them through the context of psychology and supply and demand, it's going to be much easier. Look down here, support down here, support here. This isn't a coincidence that this is where we found a bottom. It's because there was a bottom back here. Levels that were support and resistance, they can retain their importance for a long time. That's something we call market memory. All right, so hopefully that helps everybody, and I will see you soon. Thank you.